Welcome to Business Line's State of the Economy podcast, where you'll find insight, analysis, and the story behind the numbers.
Welcome, listeners, to the State of the Economy podcast from Business Line, and this is the personal finance edition of the podcast. My name is Aarati Krishnan, and I'm a consulting editor with Business Line. Today, we are very happy to have with us Mr. Shyam Sekhar, who's the Chief Ideator and founder of iThought Advisory Services, and also a very successful individual investor in his own right. It is a coincidence that today we are talking about stock market investing and long-term investing at a time when the Sensex and the Nifty have hit new milestones. So the Sensex is at 64,000, Nifty at 19,000. And usually we in the media get quite excited about such milestones. But as a long-term investor, if you look at the Sensex or the Nifty graph over the last 30 years, it's just been up and up. So should investors really get worked up about such milestones at all, Shyam?
If you are investing for very long-term goals, if you are investing towards very specific purposes, if you are investing in companies based on very clear expectations, then your investment gestation should not be distracted by what happens to the Nifty or Sensex. You must go on the individual investment merits. Naturally, some of them will change because if you are invested in the constituents of the Nifty or the Sensex, then there will be a direct consequence if these companies are contributing to their rise. And if they are very significant contributors to the rise, the individual companies may end up becoming a little bit overvalued and demonstrate more froth than you should tolerate. Right. In such situations, maybe you should respond by taking some capital out and allowing the rest of your investment to run, or taking all the capital out if you feel the froth has run too far. Right. So that relative judgment is very, very stock specific and still cannot be index centric, even if the company is in the Nifty or Sensex. If it is outside that, then I think your investment responses must be extremely company and sector centric and valuation centric. On days like this, you should not take your perspective of the Nifty into some small cap company or into a sector which is yet to really take wings. So that distinction must be made.
So today, when you do look at the markets, there are several large cap names or mid cap companies which you always wanted to own. These are fairly expensive if you see. And even in my portfolio, I saw a few stocks hitting their life highs and I was wondering what. So the dilemma for retail investors in such situations is, now if I let this run, will I lose all my gains because later the market may fall for some reason? Or should I, if I take out profits too early, then I find that I've invested in stocks with a long-term perspective, but I have lost this opportunity. I mean, that is a mistake that I make quite often, like getting out too early because I'm afraid of losing my gains. So some people follow approaches like you take out your cost and keep the profit, but that is not really a solution actually because you're still invested, right? So how should investors deal with such situations? And as a professional portfolio manager, how do you actually do this?
Over the years, I have been continuously tuning myself personally and professionally to take fewer decisions first, to not interrupt the investment journeys in individual stocks simply because sentiment or overall market valuations are intimidating. So I would always go by the individual stock merit. I would measure what that stock would give as a return if I invest in it today. If it is still going to give me lesser returns, I will just allow it to run, because if the company exceeds my expectations, then if I respond in haste today and exit or book profit or do whatever short-term technique, I would look silly in the long run. Many of the ideas which I invest in are thematically chosen. And sometimes the themes gather momentum after a few years in that industry, in that space.
Right.
So being very tight-fisted in what valuation I want to give for an individual company will be counterproductive in the style of investing that I practice. So I give myself a little slack, but at the same time, I am not going to be too lax and lethargic. In every investment portfolio, some circumstances change. Some companies don't act the way you originally hypothesize or expect them to. But the market still continues to give them a lot of license and rope. So the valuations run up with the overall market sentiment. In such instances, I am inclined to sell. But they would be exceptions rather than a rule. See, we have come out of a very difficult economic phase between 2020 and 2023. We first shrank our economy, and now we have just gone a little above regaining that original size. That's where we stand today. My sense is that we are a far more efficient economy today than we were in 2020. We are a far more actively formalizing economy today than we were in 2020. We are a far more digitized economy than we were in 2020. And we are a far more equity-centric economy than we were in 2020. So all these factors have naturally created some froth in the equity market, especially in spaces where people want to participate more. You mentioned mid-cap. Mid-cap is one such space. See, there are two things that happened in mid-cap. The very definition of mid-cap became 150 companies. I think this is not a well thought through definition. In fact, as an investor, if you ask me what is the most disappointing thing that I have seen in my experience, it is the restriction of this definition. It stands no investment logic. So I think that this definition has to change, because the change in this definition will certainly broad base our market. We need to have mid caps based on market cap. We cannot have it based on ranking. So this is not an IIT entrance exam or an IAS.
Yes.
This is based on a qualification criteria. Now you don't have a qualification criteria. You just said ranking shall prevail. So I think that the moment we move our definition of what category is large cap, what is the contour of the large cap category or the super large cap category, what is the category contribution or the contour of the large cap, the mid cap, and then the small cap, then we are going to have a far more broad-based market. In the event of this happening, I presume it will, but whenever it happens, I believe that we'll have a more stable equity investment universe. Today, it's a very unstable equity investment universe. So in an unstable universe, some parts of the market become risky. Today, I think mid-cap is a risky space, and you had also voiced your perception about individual investments that you are participating in. I believe the mid-cap space is extremely frothy, and I blame whoever made this categorization. If they had allowed a category creation based on valuation, this would have been a far more stable, bigger ecosystem, which can take in more capital and allow investors to travel at more well-discovered valuation with better discovered valuations. Now, we have denied ourselves this by this categorization. And so wherever you have this froth, I think one should take your money off the table, because when the categorization reset happens, valuation will run down. I would attribute the small cap crash of 2018 to 2021 largely to this categorization. So it impacted here in the wrong place. You see the negative side, but there is a positive side that has happened in mid-cap. Both did not pass the test of sound investment logic or reason. So if you are over-invested in mid-cap, I think that you should move to a space which is more valuation friendly. That space is the large cap space. Unfortunately, you can't move down. See, that's another problem, because I think in India, the number of people who have come into the investment market in the last 4 years is more than the number of people who came in decades before that. That's a very positive thing. But the problem is that we have a happy situation, or rather, the happy problem is that so many people want to participate in emerging companies, in companies which are having a long runway of growth, and they are all fishing in the same pond of mid-cap, small cap, and micro cap. And we have restricted mid-cap, and we have kept small cap open-ended.
Correct.
Nobody knows the lines between small cap and micro cap today. There is no categorical distinction. In the absence of that, there is a lot of confusion there. And that money, which is there in small and mid cap, has raised the valuations too much. Let me tell you why. You have a 15,000 crore SIP book. It is the duty of regulation to tell us how much of this SIP book is going into large cap, how much is going into small cap, how much into mid cap, and how much into hybrid. I think it's the basic transparency requirement of this market. We don't have it. The moment you have this data, you will be surprised to see how much money is going into small cap. This excess capital going into small cap at a pace which small cap cannot handle, the category is not well discovered, is leading to a valuation distortion. And so you cannot move down from mid cap to small cap. You can only move up to large cap. That is where you can invest. Or you can go thematically into some sectors where the economy will give more growth than we anticipate, like energy, power. When I say energy, I mean power. Or the digital space, which I think is going to surprise positively. Public infrastructure, the digital ecosystem, data, everything. The entire suite of services and products which are going to create the future digital public infrastructure for India, which is unique globally. Because you have digital infrastructure globally, but you don't have digital public infrastructure globally.
True.
I think that, so there are some spots of opportunity like that. But outside of that, you cannot take a categorical view of any specific category like small, mid, micro cap. You can take a reasonable categorical view of large cap because you can continue to invest in always, correct any valuation mistakes you can make at 19,000. But in the other spaces, you cannot correct it. So in the other spaces, you must be extremely bottom up and stock specific. Right. You must be tight-fisted in the valuation you pay, and you must be very, very watchful of to what extent the froth can run in a owned investment, in what you already own. Right. As long as the froth is within that range and tolerance, which you think you can bear for a longer term, you can allow the investment to run. Only when it becomes beyond what you can tolerate, then you force yourself to sell. And while buying, you show patience and be very, very bottom up and stock specific in the positions that you create from here. Right. So this is broadly how you can view this market and what you can do from an opportunity seeking point of view.
From what you said, I mean, it is true that many small caps and micro caps in India don't have this absorption capacity. Yet today, large numbers of HNIs and private investors, plus mutual funds, etc., PMS, everybody is chasing this segment. During market highs like this, does it really make sense for a retail investor to enter this segment? I mean, as an additional allocation, okay, but should a person enter this segment today, or should they wait for a fairly steep correction when all small caps and micro caps are crashing like anything? And in those periods, actually, they fall without a bottom because there is exit and liquidity, withdrawal, etc. So, I mean, is there a timing element to this actually?
There is a timing element, but I will define how this timing element should be handled, because that is what the small investor may want to hear. First, if you want to own small caps over the next 5 years, you can probably make a small beginning with a very small SIP. What I see today is people putting all the SIP in small cap. I will not do this. So I will probably put a very small SIP. You can call it the test SIP.
Right.
And then start tracking the sector, the valuations, understanding the companies which my fund manager is owning or I am owning directly. Understanding what would be the ideal valuation, whether the company is performing in its business to justify the valuation which we are all giving that company. And I will acclimatize myself with that space for a while. It could be 6 months to a year or even longer. And as the valuation comes within my zone, I will step my SIP up one notch. And then when it becomes more attractive, I will step it up one more notch. Okay. So I would have actually built my base SIP position itself only when the valuations are coming into a fair zone of valuation. And then when the valuation moves into an attractive zone of valuation, I will do my lump sums. Okay. Only if I do like this can I succeed in SIP investing. I can see a lot of people showing 5-year returns in SIP and then saying that it's great. Well, good luck to you. The past performance has no correlation to the future. That's not how you should measure SIPs. So I would be very skeptical of people taking all their money into SIP saying that that's the highest return, because when you look at 5-year return, it will look very, very good. But that is also due to the kind of liquidity that we have put in.
Exactly.
And not because people have conviction. Today, no fund manager has a compulsion to sell a small cap. There is no redemption. He's continuously getting money. And when I say fund manager, I am not differentiating between equity, PMS and mutual fund. And then over and above this, you have started popularizing the ETF culture in these spaces.
True.
So there is too much of idiot money That is forcing people not to sell.
Correct.
So when you move people away from selling, it's further distorting the valuation because of the sustained buying. Now, all this can change if somebody has to sell. And you will notice that the managements of these companies are selling. You are seeing
Exactly.
block deals raining all over,
Yes.
all around us. So the people who want to sell are getting a beautiful exit.
Yeah, that was something I wanted to ask also. I've seen a few PE exits, and in fact, PEs who've been invested for a very long time in some of these listed companies, they are exiting. Promoter selling is there. A lot of big deals are happening. So, is that not a sign of sort of valuation top for some?
I certainly think that large investors are taking advantage of the frothy valuations. And retail investors are buying indirectly from them by subscribing to mutual funds continuously, and the mutual funds are only absorbing these lots. In some cases, like in Timken, the management has come and sold, which is like a very, very strong signal, but the market is not willing to take cues.
Yeah.
Even after that sale, the stock price again
goes up again.
Again, it is, in my opinion, irrational institutional behavior. It's not irrational retail behavior, which is a warning bell for investors. I think that when a mutual fund buys a lot and then the same day the price goes up, you can't call it the hand of God taking stock price valuation. There is something else. There is more to it than meets the eye. Right. Unfortunately, we as a society, as a complete ecosystem, are giving more license to institutions, and they are also getting more flows than they can handle in spaces like small cap. And this money is what is giving the exits to all these large sellers. I would think that the odds of this institutional buyer, like a mutual fund, doing better than an institutional seller like a venture capitalist, private equity or promoter in a face-off is very unlikely. I think the odds are very low.
Yeah.
That is my past experience. So whenever the flows reverse, I think it will be a lot of bloodletting can potentially happen. And I think that when you have this kind of frothy valuation and then big deals at that point in time, you're setting yourself up for something bad a few years down the road. That's what I sense. Many people can call us old-fashioned, but cycle after cycle it has happened. And I don't see any reason why this time it should be different.
Do you think this time a bit of the bubble is also happening in the private markets? We are seeing these large cases of startups without business models actually struggling to get money. And certainly there is a funding winter globally, and this era of free money, free liquidity is coming to an end. So this bubble in the private markets, will that actually also affect the public market in some?
Actually, that bubble has burst. There is a bigger bubble in public market than in private markets.
Okay.
That bubble has burst because somebody wants to sell in private markets. The buyer is more ruthless today than if somebody wants to sell in public markets. That is why you had these IPOs in the Zomatos and Paytm.
Correct.
Because the private market was not supporting. Okay. Even MobiKwik tried to do an IPO because the IPO was at a higher valuation. Whereas when they have to do a round, it's difficult.
Correct.
So I think that private markets are far less licentious than public markets.
Okay. And they adjust very quickly to global realities.
They will adjust far more quickly. You would have seen that the investor in Byju's has, they have adjusted the valuation, rather written down the valuation to 5 billion from the peak valuation of 22 billion. Now, you will see a spate of write-downs now in private markets. So, whoever wants to sell is trying to do a very quick IPO listing. All that is happening.
Right.
I think the public market investor must be far more cautious now in these kind of companies, especially offers for sale. You can't have a 10x increase in the valuation of a company
in 1 year. Absolutely.
And the sellers are all private equity investors. I think that it's like you are going into a situation where you knowingly set yourself for something very scary.
So many individual investors, the last 4 or 5 years have been fairly easy to make money in the stock markets, I would say. I mean, maybe the last 1 year has been a little more difficult, but the period before that, it was every stock from the COVID low was going up 3x, 4x. And therefore, this has given retail investors the impression that direct investing is quite easy. And this has led to the popularity of both retail investors directly investing in stocks, doing SIPs and things like that, and also taking to small cases. So how do small cases and direct investing compare to a PMS, which you also manage a micro cap? I know that you have the PMS, which is a small cap.
An investor coming directly to the market should know some basic portfolio construction, some bit of equity research, and how to manage the risk in a portfolio. Somebody who doesn't know this then makes a choice of going to an organized form of advice or management. Now, small case is neither advice nor management. It's only analysis. Most of the small case guys are under RIA. Very few are under advice.
True.
And the kind of standardization which they are trying to achieve by giving model portfolios and all that in illiquid stocks makes it a investment model of very high impact cost. When you buy itself, your price goes up.
Right.
So the guy who comes next day, if he buys, it will go up further. The guy who bought 1 month back thinks he's a genius because in 1 month he has made a lot of money. And the guy who's running the small case thing will always go and keep projecting that he's a wizard. Now, all this is because of how this whole model is run. So it's structurally a very, very risky way of investing. Okay,
The thesis was that this ticket size for PMF and AI is very high. So this allows you to buy into the portfolios of big managers and things like that, right? So
let me explain this. Now I have a PMS. Now I don't discuss my stock ideas anywhere. I am true to the interest of my clients. They have come to us. We are buying stocks for them, maintaining a portfolio, and only they get disclosures. So I don't go to television. I don't send out model portfolio. I don't market by giving my portfolio. Now assume that I also run a small case on the side. I'm giving you a scenario. What happens is when I buy the same stocks, I am careful about the price of every stock I buy. Now when I give this in small case and some 5,000 people sign up, what happens is they buy by just clicking. It's click and buy. So the stock will be bought immediately at the market price.
Market price, yes.
So if my portfolio has got illiquid stocks, which it will, then if a few thousand people who are my customers in small case buy it, then it makes huge impact cost for them. And more importantly, for my PMS customers. But how the market is seeing it today is that they're seeing this impact cost as returns and more people are subscribing to both. I wouldn't want to be a part of such activity because I know the consequence. Okay. I wouldn't want to be a part of this. And this is the consequence.
Right.
And if this consequence is not seen as important for investor interest, I let society take its own decisions which are in its interest. But I would not think that this is in the interest of the PMS. I believe that if you are doing a PMS, you should be true to that.
Yeah.
By going and saying that I am serving a smaller investor, actually, I think we are creating very perverse consequences to both sections.
And you may still be building a position. Why would you want to actually disclose it in the public?
All that, everything will become high impact cost, I'm telling you. So it's very good for asset gathering, but it is not good for investor
returns.
Interest and returns. It's not good.
Yeah. So final question, Shyam. So you've been an individual investor and a very successful one with a very large portfolio. So from usually money managers and wealth managers, they start their career as analysts and they learn using other people's money, right? So they earn a lot of wealth and then they manage their private money. In your case, it has been the opposite journey where you've been a private investor. You actually seen a lot of success with stock market investing, and later you founded a firm which manages other people. So what difference do you find between managing your own portfolio and other people's money, and which is more difficult actually?
I think managing money of others is always more difficult because it's a fiduciary responsibility. It's a responsibility where more people place their fiduciary trust in you. So as you grow, the challenges increase. The amount of money that you need to manage increases. The number of people whose life your decisions touch increases. And the need to keep so many people safe on their investment journey is paramount.
Yeah.
It's not like an individual investor saying that, okay, I put my money on this. If it fails, I'm okay with it.
Yeah, true.
No, there have been a lot of people who used to say that put only what in the money in the stock market that you can lose. We have heard all these theories. We are not catering to that society anymore.
Right.
We are catering to a more aspirant aspiring society, aspirational audience who have earned their success in their life and who are bringing their money to this area, to equity or debt. So as a manager, our responsibility today is far more than what it was 10, 20 years ago. And we are also needing to build a team, a culture that will serve that responsibility correctly for a very long time to come. So that is the most challenging part. But the rewarding part is that earlier I had to create my own portfolio, which only I manage. I am the largest investor in 2 of my PMS products. In Solitaire and Riddhi, I am the largest investor. And over time, I will be the largest investor in more products because I want to create a professionally managed, advised portfolio approach. So by doing that, I think that progressively I will be able to increase my skin in the game. And that in turn will also act as a protection for all the investors who are traveling along with me. So that is broadly what is the difference between being an individual investor and being an investor in being a manager, professional manager. Outside of that, a lot of my individual investing today is in enterprises which are not even listed. There, I am using my experience as an investor to help companies grow, to help them monetize themselves rightly, and to also make them live up to the expectations of the market over the long term.
So you're mentoring them basically to an extent.
It's a very rich word, but I would say I am participating in their journey and trying to contribute.
Right.
So that is one thing which I am doing more in my personal capacity. I do have a few investments which I am carrying from the past, which I am holding. There are some investments which I cannot buy for others, which are very, very risky, which I can not buy in a public market portfolio. But increasingly, the bulk of my portfolio will also need to be invested in such investments which are moderate risk. Over a period of time, I expect that my personal investing will slowly reduce in public markets, and more of this public market investing will serve my personal needs also. So in that sense, I thought sits in the middle of what I need in the future.
Right. Thank you so much, Shyam. I think that was very insightful.
Thank you so much.